Welcome to This Explainer. Grab a seat and make yourself comfortable. Today, I want you to imagine that I'm your personal financial advisor. You've just stepped into my office, and we are going to diagnose and hopefully cure your deepest financial anxieties. People so often say they're just generally afraid to invest, but treating that as one giant blurry fear is actually a huge mistake. If you treat investing anxiety like a single phobia, you'll end up making the right decisions for the completely wrong problems. So we're going to break down the 4 distinct fears of investing today, and then I'm going to give you a highly pragmatic, actionable prescription to cure them.
So, let's kick things off by having you take a really honest look in the mirror. What kind of investor are you right now? As we go through this consultation, I really want you to try and self-identify. Be brutally honest with yourself, because figuring out exactly which psychological profile you fit into is the absolute first step to getting out of your own way and finally making your money work for you.
Out in the real world, we tend to see 2 main financial archetypes. Let's meet them. On one side, we have Stefano. He's 42, a mechanical designer, and he's got 85,000 euros just sitting in his checking account. He is a super diligent saver, but he is completely paralyzed by the fear that if he invests, some massive global crisis will wipe out his money forever. On the other side, we have Giulia. She's 34, a project manager, and she actually did the right thing. She invested 40,000 euros into a global ETF 2 years ago. But man, she is incredibly anxious. She checks her broker app constantly, and every single time the market dips, her stomach just ties itself into knots. So, do you see a bit of yourself in Stefano? Or maybe you're more of a Giulia. Or honestly, maybe you're a mix of both.
Now, before you start feeling bad about identifying with either of them, let's turn to a quote from one of the great philosophers of our time, Rocky Balboa. He says, "Fear is a fire. If you control it, it warms you. But if it controls you, it burns you and everything around you." Having fear about your hard-earned money is a completely healthy, evolutionary, protective mechanism. It's literally what stops you from doing reckless things. The goal of this explainer is absolutely not to tell you to eliminate your fear, because that's impossible. Our goal is to channel that fear into prudence rather than paralysis.
Okay, part 1. Stefano Syndrome, permanent loss and inflation. Let's step into the examination room with Stefano, our paralyzed saver.
Let's diagnose Stefano. He is dealing with 2 specific issues. First, he has a terrifying fear of permanent capital loss, this deep-seated dread that his money will vanish and just never come back. But the second part of his condition is one he isn't even fully aware of, and that's the silent erosion of his wealth through inflation. You see, keeping money in cash feels incredibly safe because the nominal number, that actual amount of euros you see on your banking app, it doesn't go down. But in reality, hoarding cash guarantees a loss of purchasing power over time. Just think about the 1.5 trillion euros currently sitting completely dormant in Italian bank accounts alone. That is a literal mountain of wealth that is slowly bleeding out its true value year after year. It's this mental trade-off we make. We accept a slow, quiet loss just to avoid the perceived risk of a loud, disastrous loss.
But I want you to look at this number right here, 4.3%. That is the aggregate, historically realized real return, meaning the return above inflation, of developed global stock markets over the last 124 years. Really think about that for a second. Through 2 world wars, the Great Depression, the Cold War, the dot-com bubble, the 2008 financial crisis, and a global pandemic, the global market fundamentally grew. Now sure, past performance is never a guarantee of future results, but this number proves that over the long term, structural economic growth is a very, very real force.
So the absolutely crucial point here is how we cognitively reframe what the stock market actually is for Stefano. The whole phrase playing the stock market is just toxic. You are not at a casino gambling on random lines moving up and down on a screen. When you buy a broad stock index, you are buying a direct, real-world claim on the future free cash flow and the real profits of actual operating companies. We're talking about companies that are inventing new tech, developing life-saving medicines, and providing everyday goods and services to billions of people whose standard of living is slowly rising. You are quite literally participating in the fundamental growth of the global human economy.
All right, part 2. Giulia Syndrome, the anxious investor. We've tackled Stefano's fears, but what happens when you've already started investing, like Giulia, but you are still stressed out of your mind?
Giulia's diagnosis is a completely different ballgame. She fully understands the logic of long-term investing, but she is suffering from a massive fear of daily market volatility, along with this lingering anxiety that she's making some sort of technical mistake. Every time she opens her app and sees her portfolio drop by 2%, the panic just sets in.
What we really need to understand here is that periodic market declines, even drops of 10 or 20%, are honestly just the market's spring cleaning. They sweep out the investors who took on way more risk than they could handle. Volatility isn't a glitch in the system. It is the absolute necessary price of admission you pay to gain those long-term returns. If you completely eliminate the volatility, you eliminate the premium you earn. It's a package deal.
And the root cause of Giulia's pain is glaringly obvious when we look at the data. If you check your portfolio daily, history shows you have about a 48% chance of seeing a negative return. It's basically a coin flip. You are artificially subjecting yourself to the psychological pain of losing money almost every single day. If you check it monthly, well, that drops a bit to 40%. But if you only check it yearly, your chance of seeing a negative return plummets down to just 25%. Giulia is literally creating her own misery simply by opening her broker app way too frequently.
Behavioral economists actually have a clinical term for Giulia's exact condition: myopic loss aversion. It's this fascinating phenomenon where your natural human dislike of losing money is severely, artificially amplified by the bad habit of evaluating your portfolio too often. Giulia has a massive mismatch on her hands. She has a 20-year investing time horizon, but she is monitoring her results on a 24-hour cycle. Think about it like planting an oak tree and then digging up the seed every single morning just to see if it grew. You're not helping it. You're just going to kill the tree.
Moving right along to part 3, the cure for volatility. We've successfully diagnosed both Stefano and Giulia. Now it's time to head over to the pharmacy and discuss the practical cure for this paralyzing market turbulence. Here is where we implement what I like to call the 3 golden rules for handling volatility. Number 1. You have to mentally accept volatility as the required price of admission for returns. Without it, you get nothing. Number 2. You must match your monitoring frequency strictly to your time horizon. If you're investing for 10 years, looking at a daily chart is completely, utterly irrelevant. And number 3. Establish an external behavioral rule for checking your investment app. I really want to emphasize that third rule: external rules. Relying on sheer willpower to stop checking your app, it just doesn't work. When the news is screaming about a market crash, your brain will physically force you to look. You need a strict, predefined rule. For example, tell yourself you are only allowed to log into your brokerage account on the solstices and the equinoxes. That's 4 times a year, right when the seasons change. By writing a rule like this down, you prevent yourself from self-sabotaging your long-term wealth purely out of short-term myopic fear.
Finally, part 4, the prescription. Your actual action plan. Let's see how all of this builds into a concrete reality to cure that very last fear, the anxiety that you're technically messing up your portfolio. To totally cure technical anxiety, you have to completely remove decision-making from the process. Here is your highly pragmatic 3-step technical cure. Step 1, keep it radically simple. For the vast majority of people, a broadly diversified low-cost global stock ETF and maybe a global bond ETF based on your risk tolerance is literally all you need. Don't try to pick winning stocks, just buy the whole haystack. Step 2, automate. Set up a recurring monthly transfer right from your bank to your broker. You don't decide when to enter the market, the machine does it for you every single month, rain or shine. And step 3, rebalance only once a year. That's the whole shebang, one single solitary technical decision per year.
So I'm going to leave you with this final provocative thought. We've dismantled the fear of permanent loss. We've exposed the invisible threat of inflation. We've tackled the anxiety of daily volatility. And we've cured the stress of making technical mistakes. The entire plan is laid out in front of you. So my question is, are you ready to let a simple, automated strategy do the heavy lifting while you get back to actually living your life? Stop trying to optimize everything purely out of fear. Stop being paralyzed like Stefano, and stop being artificially stressed out like Giulia. Just start. The best time to take control of your financial future was yesterday, but the second best time is right now. Thanks so much for joining me on this explainer, and I'll see you next time.